Okay, as people file in, you can just use the chat and say where you're from, where in California, where out of California, because I guess we're taking people from everywhere, Rebecca. What
Mhm.
size firm you have. If you use a firm management software, what software you're using. So guys, as you're filing in, just jump into the chat and start letting us know your size firm, where you're from. Say hello to your friends as you see them in here. Okay, Los Angeles 8 People Monograph, yeah. Woodland Hills, yeah. And yeah, say what software you're on. That's also interesting if you're using any firm management software. Jira, BQE, Monograph. Okay, so we have a wide spectrum. Anyone on Factor or Synergy out of curiosity? Deltek, yeah, Jira. Uninet, okay. Give a little comment. How do you like Uninet? Jira, Deltek. How do you like Jira? Out of curiosity, there's a lot of Deltek Jira people. Interesting. Yeah, Harvest user. Oh, Squava. Squava I haven't heard of. That's new to me. Yep, Vantage. We have New Jersey, my home state. West Orange, New Jersey. Okay.
All right. Well, thank you, everyone, and welcome.
Thank
We're
you for
happy that
sharing.
you're
Yeah.
here with us for this AE Profitability webinar. As you get started, just a few reminders. Please use the Q&A section for any questions, and remember to be constructive in any of those questions or comments to the presenters and to one another to ensure that we have a session that is productive. Also, AIA California will submit one AIA learning unit for those who complete the session live. And as always, the webinar content and additional resources will be available online shortly after the session. Today's Engaging Financial Bootcamp style webinar is brought to you by BQE. It qualifies again for one AIA learning unit for those watching live, and AIA California will report that for you once you have finished the session in full. Now, to quickly introduce our presenter, Douglas Teager, FAIA, graduated from Cornell University in 1982 with a Bachelor of Architecture. He opened his own firm in 1989 and grew from a solo practitioner to become managing partner of his 32-person firm. In 2009, Douglas received his master's in spiritual psychology from USM, where he learned tools and skills that he is sharing with his staff and clients. His ability to effectively streamline the operations allowed for more time to be spent on design and project research while creating a culture that fosters a holistic approach to work-life balance. In 2017, he served as the president of the AIA Los Angeles chapter and previously served on the AIA National Strategic Council. In 2019, Douglas transitioned out of his firm, elevating 3 associates to partners, sold his shares, and started his next venture, Teager Consulting. Douglas's mission is to live an inspiring, balanced life, whether it involves family, coaching, consulting, painting, or sports. Now on to today's presentation. Thank you so much for being here, Douglas. Please take it away.
Okay, thank you so much. I'm going to share the screen and then go to, let's say share. Yes. And then screen 2, share. And then I'm going to turn off the video so I can focus, and I'll come back on during Q&A. So thank you, guys. I want to say thank you to the staff at BQE Core and AIACA that I miss. I served on the board there for a couple years. To keep the intro even shorter, you can go to my website and read about my background and personal journey. As Rebecca said, I've been managing partner for over 20 years, developing best practices for my own company And now I'm consulting and sharing this information, assisting firms to increase profitability and improve firm culture. I like to say that the intellectual property is your design. The foundational processes that I'm talking about in these 12 webinars should be shared with everyone. Running the business should be shared of how we can all be successful as a business. And then your intellectual property is your great design creativity. So for me, I like to say we're partnering together to make a difference through defining and achieving your business and personal goals. I recommend books on every webinar. There are so many great books and resources available for running a firm and your life. And I do talk about both of those. I want to share a few of those with you at the beginning of each of these webinars. First is a book called Traction by Gino Wickman that talks about a system called EOS, or Entrepreneurial Operating System. This is a foundational book that can bring value to each of your firms. It has so many great ideas and concepts. I'm not going to summarize them all here, but the book starts with the understanding that every business requires marketing, operations, and finance, the ability to get the work, do the work, and be paid for the work. These three departments typically work under an integrator that manages the firm, and above the integrator is a visionary setting the direction of the firm. As a small firm owner, you have to wear all 5 hats to create a truly successful firm. As you grow, you can delegate what you're not great at and hire the right team. Creating processes for all the aspects of the business is challenging and time-consuming, but it will save hundreds of hours down the road for you to be doing what you want, and for any new employee to have a resource to go to for how any task is performed your way. So the course outline for these 12 webinars serves as a roadmap to help you develop some of these practices and processes. The Business of Design by Keith Granite is a resource covering what we're talking about in these webinars. It doesn't go into the detail of what I do and what we're discussing, but it does a great job of presenting an overview for your practice. And then Steve Burns has his company is called The Well-Designed Firm, and I love the meaning of that of his firm name. We all design homes and we spend so much time in design. Why not design your firm and really think about and create the foundation and structure and look and feel of your firm the same way you design your project? So once again, these 12 webinars are really a tool to help you do that. We're on Understanding Profitability, which is 7 in my series. You can go to the core BQE library to hear the others, or I'm sure AIA CA is going to put on some other ones. But they are sequential and they build upon what you've learned in the previous ones, but they're also standalone. So today is really a great webinar on understanding profitability. There are many different ways to look at profit, analyze profit, and understand profit. But at the end of the day, we look at how much money is in our bank account at the end of the year. On a cash basis, this equals total income minus total costs and expenses. Our discussion today is taking a deeper dive on various factors that can affect profitability. There is no right or wrong to what is the ideal profit number. A solo practitioner who has developed an amazing work-life balance with a practice that supports this lifestyle is perfect for that solo practitioner. My most profitable clients have systems in place that provide data as to why their profit is going up or down. We're going to look at the difference between project profitability versus office or firm profitability. We'll go over pay rate, cost rate, and bill rates. Understanding your cost rate is the most important metric for establishing and understanding profitability. We'll review the billing potential worksheet and use that as a goal for our monthly invoice target. And then you can download this worksheet from my website. But it has a lot of information in this one worksheet. We'll look at the difference between utilization rate and efficiency rate. And then if we have time, we'll see how all these tie into the dashboard and scorecard, which we'll cover in depth in next month's webinar. To understand profitability, we must look at the associated costs. We can find these by running a P&L or profit and loss statement through our accounting package. I like to run these seeing a breakdown by month with the year-to-date shown on the same report. Let me get you up to where you're at. Rebecca, are you seeing project costs? Because I'm one slide behind.
Yep, I see project costs versus office costs.
Got it. Got it. Okay. So to understand profitability, we must look at the associated costs. As I said, we find these by running a P&L. These should be broken down with project costs or reimbursable costs and what is billed to the client, and then office expenses or operating expenses. We went through this in the second webinar. The 5,000 accounts are project costs, which equal billed to client, and the 6,000 accounts are office expenses, which equals overhead. I'll show that in the next slide. The 5,000 accounts can include the direct labor portion of payroll, or we can just cover that in the 6,000 and just move it around. The 6,000 accounts include the indirect labor portion of payroll. If not, we can separate the payroll between direct and indirect to determine our cost rate later. This is really an important factor, is understanding the difference between direct labor and indirect labor. Direct labor is all effort that goes to a project, whether you're paid for it or not. Indirect labor is all your overhead, marketing, business development, PTO. So for project costs, we need to look back at webinar 2, chart of accounts. We define all outgoing cash in one of two categories, either reimbursable costs that we spend on a client's behalf for the project, or office overhead or operating expenses, which is everything else you spend your funds on to run your office. This is why having a clear, organized chart of accounts is so important. And then I like to break down the 5,000 account into 4 main categories. 5,100, which covers all direct labor associated with the project. And then I use the word associated, which means all time worked on a project, and I said this before, all time worked on a project, whether it is billed to that project or not. So for example, if an employee enters 10 hours on a project, but you can only bill for 6 of those hours, there are still 10 hours of direct labor captured here. I've met with some offices that if you can't bill it to a project, they bill it to overhead. Stop doing that. Let's call a spade a spade. Let's understand if you're working on a project, then all effort, whether you're paid or not, is billed to that project. If it's a fixed fee project and you have used up all the fee in a phase, then any time over the fee amount is still considered direct labor. So, I've met firms that have categorized the extra time, which equals money, as overhead because they cannot bill it. But really, stop. This is not an accurate method of accounting. We will understand why when we review the potential billing. It'll show us why this is the difference between utilization rate and efficiency rate. And this is a big clarification that I'll get to later in this presentation. Utilization means all hours worked on a project, your direct labor versus all other hours, PTO, staff meetings, time slip, office cleanup, marketing, biz dev, etc. This is what's considered indirect labor. Efficiency is what percent of the billable work, direct labor, do we actually get paid for? And once again, even at the partner level, keep track of all your time, even if it's on marketing and business development. We have to understand what your true utilization is. I have a lot of partners that only enter their time for their project-related hours, but it makes it very hard to do a true analysis of what their utilization and realization is based on that.
Hey,
So
Douglas,
if we come, go ahead.
I think we may be looking at the wrong slide. I think you want to advance.
We're still on the 5,100. I'm going to get there in a second.
Okay.
Um,
Saying some comments.
and yeah. I don't think we're one slide behind. But let me just finish up this one and then I'll check on the slides. So all billable work is not necessarily billed. And the program like Core or Jira, they track this metric nicely. To review the remainder of the expenses categories and chart of accounts, I got on a little tangent. Sorry about that, guys. So coming back to this slide, 5,200 are all costs associated with paying consultants that are under your contract. For small firms, having an owner sign the consultant agreement and pay directly might be easier. But if you do take this under your umbrella, then charge a 15% markup. If the owner does not want to pay the markup, then have them sign and pay the consultant directly. You're not a bank, and the markup covers your E&O insurance associated with this, as well as the admin cost for paying the consultant. Then 5,300 are all the project-related expenses. Many architects just pay these as office expenses, but stop this. 5,400 is for other items that are typical costs that are passed through to a client. So in summary, the 5,000 account category is for all reimbursables, which I consider a money in and money out account. The only profit here is the markup, which just covers the admin time and E&O associated costs, even if that. Okay, for office costs, so now we're in the 6,000 category. So the 6,000 accounts are all other office expenses that cannot be billed to a client. And guys, if you haven't seen my chart of accounts webinar, it goes over the logic for all of this. So typically, these are considered your overhead costs. I'll not go into this in detail. We previously covered it, but please stop giving away items that are justifiably considered a reimbursable expense. Many of my clients, when I first started working with them, did not separate costs and expenses. This is critical to change and implement immediately. Once again, if you've not already set this up, then go back to your chart of accounts and really revise it. So your 5,000 category are your reimbursables, your 6,000 are only your operating expenses. We're going to review pay rate, cost rate, net rate, and bill rate one more time. And this is the cornerstone of understanding project profitability. Pay rate is the hourly rate, which is the same as the yearly salary divided by 2080. 2080 is the US standard for number of hours in a work year. 52 weeks times 40 hours a week equals 2080. This is before PTO, company holidays, sick days, etc. So whether someone is part-time or 1099, we need to establish what is their pay rate. The overhead multiplier is a calculation based on the total indirect expenses divided by direct labor. The cost rate multiplier is the overhead multiplier plus 1 times the pay rate. The pay rate times the cost rate is your break-even rate, or I call your cost rate. This is critical to know what your profit's going to be. What does it cost you to run your office? The cost rate multiplier is like a burden factor. For every hour that your direct labor staff has to work to cover all the other labor that's indirect and all the office overhead, that's your cost rate multiplier to break even. Your net rate multiplier is taking your hourly rate times your net multiplier, which already includes your desired profit. And then finally, the bill rate is the hourly rate you charge for your various staff levels or roles. The bill rate should equal or be higher than the net rate to make your desired profit. We'll get to a formula that'll show you a spreadsheet that'll help put a graphic to this and have it make sense. So diving a little deeper, the net rate multiplier equals the hourly rate times net multiplier, including desired profit. The formula is shown here. Cost rate multiplier plus, and this gets into the formula, cost rate multiplier divided by 1 minus the desired profit minus the cost rate multiplier, but it's all set up on my spreadsheet. The formula is embedded in my potential billing spreadsheet, so if you just click on that cell, that'll give it to you. Calculation is automated. All you need to do is enter your desired profit. And then your bill rate is just the hourly rate you state in your proposal for your staff. The takeaway here is that the bill rate, and I'm saying this again, should be equal to or higher than the net rate to come close to your desired profit. That's why I don't mind using a slightly higher desired profit, because this is assuming you're billing 100% of your hours, and most firms don't do that. So I like to use a higher profit rate here, because rarely is every hour worked on a project billed to the project. So typically, a firm's profit falls somewhere below this ideal target. It's also possible to be higher than this estimated profit if you complete fixed fee projects under the budget amount, or if your staff puts in a lot of overtime, which I am not a proponent of. I want your staff to be on a 40-hour work week, have a work-life balance, and be able to schedule and get your projects done within that within that 40-hour week. To calculate the basis of the cost rate, we need to define the items in red on my spreadsheet. And this is direct labor, which includes all taxes, benefit, and insurance. This is all time associated to a project, whether billed, not billed, or unbilled. So indirect labor includes all taxes, benefits, insurance. This is for all other time not spent on a project-related work. Or another way, this is your overhead. It's admin. It might be staff meetings that are not project-related, but office-related. Entering your time at the end of the day, office celebrations, office cleanup, lunch and learn, standards, PTO, whatever you want to define as your non-billable time, keep track of it. And I also have a great activity list and a whole time tracking webinar that talks about time in buckets and makes it easier to track time. So if you do not separate this number on your chart of accounts, then we need to use a utilization report and then use those percentages times the payroll to understand what is your direct labor versus indirect labor. So ideally, this is done individually for each employee. And then next, indirect expenses is everything it costs to run an office. Rent, supplies, phone, E&O, everything in the 6,000 accounts of your P&L if it's set up correctly. It does not include any reimbursable expenses that are billed to a client and are typically part of the 5,000 account. That's why it's critical to have a clean chart of accounts. Then the desired profit as a percentage. Remember, this is not an indication of your firm's profitability. This is an optimum potential, and your firm profitability will most likely be less due to inefficiency of billable time. So this is different than utilization, and we'll get into realization a little bit. Now we can jump in and make some assumptions and estimates to understand what our potential billing is and possible potential profit. So this is all part of a complex spreadsheet that'll just really act as a what-if scenario. If you add an employee, if you give an employee a raise, whatever is in red are basically the levers we can manipulate. And the spreadsheets are always open, so you can add lines, delete lines, and make it work for your firm. So this spreadsheet is used as a tool to set a monthly target for your potential billings, as reflected on your monthly invoices tracked on my scorecard. So this is also a tool to understand the potential revenue generated from an employee based on their utilization and salary or pay rate, cost rate, and bill rate. This holds true if you're an 18-person firm, a 4-person firm, a 2-person firm, or even a solo practitioner. You can understand what your monthly invoice target should be. So let's jump in and look at this for I'm going to use a 4-person firm, and even we can look at a solo practitioner. So do a save as on the template when you download this, and then save it for your current firm size. Plus, I keep 1 or 2 extra rows left empty if you're going to hire someone. I'm always optimistic for your firm's growth. Just hide the other rows instead of deleting them. But delete all the red items in the blank rows before you hide them. Delete all the red items or make them 0 so they don't add to the summary formulas. I hide the unused rows so they're available in the future and the formulas are still intact. If you just add a line, you're not going to get a formula when you add it. You have to drag down everything to get the formula. So you have to know a little something about Excel. In the highlighted, in the yellow box, you'll enter the name, title, and base salary before bonus and benefits, okay? Because your bonus is really your profit. So this is used to get the pay rate, and then your benefits are covered in your overhead expenses. So I just wanted you to enter their salary. This is used to get the pay rate per hour. This is simply, as I said, the yearly salary divided by 2080. Once again, 2080 equals 40 hours a week times 52 weeks in a year. Next, we're going to look at the utilization rate. So if you're using Core or any other time management system, this should be easy to get an accurate number. Most firm owners do not understand that the starting point for a highly utilized employee is 85%, not 100%. Let me explain. For a salaried employee, we pay company holidays, sick days, and personal days, or I like to lump them as PTO. So in this example, I'll show how many work days in the given month. This changes slightly year to year, but it's approximately 261 work days in a year. How many company holidays do you provide? So this example uses 8, but you can just edit the spreadsheet to match your firm's policy. How many sick days you provide per year, and then just divide by 12 to get an average day per month, and confirm with your state requirements on this. How many vacation days you provide, just use an average if it varies by employee. So this example uses 2 weeks, 10 days. So here we have a net of 237 work days times 8 hours per day equals 1,896 possible work hours, excluding any time over an 8-hour day. As I said, my goal is always to have a life balance within firms and hire the right number of staff and the right staff to get the work done within an 8-hour day or 40-hour work week within the defined project schedule. This ties back to our time budget webinar of how to plan out a project. And yes, there are exceptions to meet some deadlines, but I don't want overtime to become the norm. The point of this calculation is to show that off the top, the maximum utilization any employee is about 90%. If we add 1/2 hour to 1.5 hours a day, that's 2.5 to 7 hours a week of non-billable time, such as staff meetings, time entry, cleanup, bathroom breaks, answering the phone, which all contributes to lowering the adjusted utilization of 90% even further. So as an example, using 1 hour overhead time per week times 52 weeks a year divided by 2080 equals another 2.5% drop in utilization for every 1 hour a day of overhead. If you divide 1 by 40 hours in a week, 1 hour out of 40 hours in a week, that's 2.5%. So assuming 2 to 3 hours a week of overhead related time takes us down to a utilization closer to 85 to 80% maximum. So if you see numbers at 95%, typically this means you set your global settings to 8 and your staff are entering more than 8 hours a day or have not taken PTO, vacation, or sick days in a while. So this spreadsheet is based on including PTO for that utilization. Some firms exclude overhead and just look at worked billable hours for their utilization. I like to look at both numbers simultaneously. So coming back to our potential billing calculator. We now understand that a realistic maximum utilization for this calculation is 85%. A partner who spends time on marketing proposals, firm management might be around 50, 60%. Some might even be less. A senior person who might be at 70% because they might assist on some proposal writing and other non-billable tasks. And then your intermediate and junior staff will probably be around 80, 85%. I am not telling you, and I never tell you what numbers to use. You need to enter the reality of what this is at your firm. This is why accurate time tracking is so important in understanding profitability. Without it, we're just guessing. So then this spreadsheet auto-calculates into the direct labor and indirect labor cost at the pay rate. This does not include the taxes and other payroll costs. I like to include in the direct and indirect numbers, but it starts to give you a very good estimate of billable to non-billable labor costs that we can use as a ratio later on. Next, we need to calculate the cost rate multiplier and net rate multiplier. To do this, we need the direct labor costs, including the proper ratio of payroll tax, health, and other associated payroll costs. We then enter the indirect labor costs, including the proper ratio of payroll taxes, health, and other associated costs. And then we need to enter all other indirect expenses. The reason we enter all associated payroll costs to direct labor is that the cost rate multiplier or break-even multiplier is a ratio of total indirect costs divided by direct labor costs. If the indirect labor increases due to absorbing the indirect expenses increase due to absorbing all the added costs of the other payroll costs and taxes and health costs, then the multiplier increases and profitability decreases. The lower the overhead, the higher the profit. The only way to get accurate data here is an accurate chart of accounts covered in webinar 2. We then put in our desired profit. So this is a maximum target, but a poorly run project can lower this percentage. Therefore, I like to just see what a 35% or 45% target does to my net rate, or what I need to establish for my bill rates. This percentage is not telling you the firm profitability. It just lets us know what is the minimum hourly rate we need to charge to reach this target. Multipliers of 2.1 and 3.24 will tell us what is the cost rate per employee and then the minimum bill rate to achieve this target. In this example, if the partner's salary is $150,000, the pay rate is $72.12 an hour, the cost rate is $151.75, and the minimum net rate to achieve a 35% profit is $233.47. So if the partner is billing at $225 an hour, then it's not possible for the partner to reach a 35% profitability, but the partner is still profitable based on the cost rate. So why is there a negative 81,000 profit shown on the far right? It's that the partner is only billing 50% of their time. For the other employees, we see the suggested net rates are all lower than the actual bill rate. This is good. I like to have salary ranges that fall under a standardized bill rate of say 125, 150, 175. And then internally, there'll be a slight fluctuation in actual profitability per employee. But it'll all balance out if we just use these standard bill rates and have your employees fall into bands. So Core, Jira, the other programs do a great job of providing the data to calculate this information. The purpose of this spreadsheet is not to tell you what to bill, just to inform you and confirm if your bill rate is over your net rate to maintain your desired profitability. Once again, this does not account for a poorly run project or a well-run project that can make this percentage go up or down. Nor does it take into account a major overhead expense not accounted in the setup cells. This is why I like to update the multiplier factors at least twice a year or after a new hire or new consistent expense. We typically use a 12-month trailing data, but if you know that direct or indirect labor or overhead funds are going to significantly change in the future, then rerun the numbers and see the new outcome. In this example of a 4-person firm, if the cost rate drops from 2.1 to 1.9, that's basically 0.2 of a point, the potential profit increases by 71,000 plus change. Remember, this spreadsheet is not telling what your firm's profit will be. It's telling you, based on the salary, the utilization, the cost rate, and the bill rate this employee has the potential to bill this amount. What affects the actual outcome are your project management skills. Can you complete the project in the number of hours allocated based on your fee? And webinars 3 and 6 cover this topic. The other important number the spreadsheet provides is, what is your monthly billable target to reach this goal? In this case, your monthly goal is to invoice $68,500 of fees. If you're not coming close to this number, you need to confirm the utilization percentage and then the project efficiency and realization and dive deeper by figuring out why. We'd next go into the utilization report to see if these numbers are accurate, and we'll look at that in a few slides. Even a two-person firm, which typically has lower overhead and maybe lower salary and bill rates needed to generate 400,000 annual revenue, or approximately 32,000 a month to reach the goals estimated in this example. I share with my clients that I cannot bring in the work for them, but if you can bring in the work, I can provide tools and guidance to help you put systems in place for you to understand your firm and project financials. The utilization rate is simply how much time is spent on billable hours versus non-billable hours. I define billable hours as any effort that can be charged to a client, whether it's billed or invoiced to the client or not. If you are on an hourly project and you have a gut sense that sending an invoice for 30 hours for a bathroom vanity is too much, and you bill 20 hours, then this is an example of a billable amount of 30 hours, but a non-billed amount of 10 hours. So hours times bill rate equals the invoice amount. The same is true of a fixed fee project that goes over the allotted fee and associated hours. Overhead hours is everything else. So PTO, vacation, sick, company holidays, staff meetings, entering time, cleanup, as I said before, all your admin time that's not charged to a client is your overhead hours. Core has great reports to help you see employee utilization. They break down this in direct labor into project-related costs and associated work on a project, and then non-bill, which is still direct labor, but not billed to the client for one of two reasons. As I said, either you're over on a fixed fee or you decided not to charge on an hourly project. The firm average is 70% utilization. We got here by adding the billable amount of 64.8 plus the non-billed amount of 5.2. But if we look at the principal, he's only 40.9% utilized, with a stellar PM at 89.8%, which is because he did not take all of his 2 weeks vacation or sick at this time in the yearly cycle. Overhead related costs include all the other time, such as biz dev, marketing, overhead, PTO, and comp time if you use comp time. Note, an employee should not enter comp time for extra hours worked on a project, but the hours that they took off as a paid time off that make up for the extra hours worked. And this only applies to salaried employees. I like to look at office profitability on a cash basis. What is the total amount of money spent during that month, and what was the total amount of money received during that month? The difference is the company profit for that month. For example, using round numbers, if you spent $100,000 in July and received $120,000 in July, your profit would be 120 minus 100 equals 20,000. The profit of 20,000 is divided by the money spent of 100,000, which equals a 20% profit. So the formula for profit is the profit percentage equals the profit divided by the cost times 100. Now, we have to make a lot of assumptions, but bear with me. Assuming this is month 7, July, it would be logical to assume that most of the funds received during the month of July are from invoices primarily sent out in April, May, and June. This would be the bulk of your accounts receivable, commonly called AR, which range from 30 to 60, sometimes 90 days past due. There might even be some money from accounts that are over 90 days. So this is a red flag and reminder for you to call these people and collect on that payment or understand the reason why it's over 90 days past due. So the money coming in has no direct correlation to the work effort spent in that month. Next, we're going to define project profitability. It's obvious that if your income does not exceed your office expenses, you're not going to be profitable. Three main factors that potentially reduce office profitability are: one, having too many non-billable administrative staff for your size office. I'm all about delegating and hiring admin people, but there has to be enough cash flow driven by project profitability to support this. This is why looking at profitability on a monthly, quarterly, and yearly basis using a scorecard is important. Second reason, your technical staff has a low utilization rate or efficiency rate. So your staff is spending time on non-billable work such as marketing, admin work, or other excessive overhead time. You do not have enough billable hours of backlog work to keep your staff at capacity, and as such, they spend more time than is allocated on a project, or if they work on office overhead tasks. Or it could be your staff is not efficient on completing tasks within the allocated project budget. This is true whether a fixed fee or an hourly project. On a monthly basis, analyze your employee utilization. Look at these reports. Compare the billable versus non-billable time. We'll look at this in the next slide. So then third, your office expenses are more than you can afford at this time. Is your rent too high? Is now the time to buy that new furniture? Develop a budget for consistently upgrading your technology. Waiting until it's too late, then this becomes an unplanned expense, which can be the difference between a profitable or non-profitable month. I'm all about marketing dollars. But are there ways to save money? For example, project photography is usually paid for by the architect. But you can also get consultants, contractors, or subcontractors to contribute to the photography costs and then save some money. It's up to you as the firm leader or firm owner to make tough decisions to chart a path for profitability. So here, the core employee performance report is a good overall place to start to understand how someone is spending time. Here, for example, I see Jan DeMarco is 88% utilized, made up of 82% billable plus 5.2% non-billable, which equals 88. Not bad. I see that there is 6.31% for the general overhead category of 75 hours. So to understand where they're spending time, we need to just dig a little deeper. And in core, we use something called the time and expense reviewer. So in the time and expense reviewer, we need to set up a few filters such as time period, employee name, associated overhead items. And then we can sort by clicking on the item or any of the headings. So I look and see that Jan spent 144 hours in general office overhead and spent 29 hours installing software over 1 month. So I would just ask the question, just be curious. Is this the best use of her time, or is using an IT person outsourced might be a more efficient way to install software? It's for you to analyze. I'm not telling you what to do. Just think about it. Look at the data and be curious as to why something might be off. So many firm owners have this great software, but they're not using it. They're just, using it for the invoicing, but not digging deeper. So make use of this and dig deeper and understand why are you not hitting the targets that you're setting, or start to set targets and then analyze that question. So project profitability is also a very simple calculation, but it hinges on accurate cost rate multipliers. What is the total value of service sent out for a current month minus the break-even cost of those services in that month? This assumes your company bills on a work-done basis, which I highly recommend, versus milestone billing. What was the cost of direct labor in July deducted from the invoice amount you were able to bill in July, excluding reimbursables? So then you can run a profitability report for each month and add this number to the scorecard to see month-over-month progress. If you bill on a milestone basis, for example, at the completion of each phase, you can still track profitability, but not clearly on a monthly basis, since you are not linking your labor costs in any month, the cost to perform these services, which are the hours times the cost rate, to the dollar amount invoiced in that month for those services. So I urge you to switch to a monthly billing on a worked-earned basis. I even like my invoices to be dated the last day of the month, so it keeps everything very clear that an invoice dated April 30th is for all the work in April. So I do not focus on the reimbursables because that's simply a money in and money out, and it's basically a wash, except for the 10 or 15% you add for markup. This typically does not significantly move the needle on profitability unless you're carrying tens or hundreds of thousands of dollars of consultant contracts. 15% of $1,000 a month is $150 for every $1,000 of reimbursables. This becomes a monthly light item to watch again if it does become significant. What I really care about is the profit margin you're running on your projects based on your service labor billed minus the cost of that service labor. The most accurate way to see this trend over time is to bill for all effort during that month. And we can look at this number in two ways. Hold on one second. Hey, don't cut the Okay. So if in core, you can see this as the cost analysis report as a dollar amount and percentage by phase or by master project. This shows the amount you build your services in any month of July versus the cost of those services in the month of July. And then see the project percentage by phase or overall. The caveat here is if you did not bill for 2 months and then run invoices, it'll attribute all the time spent for the prior 2 months and the associated service cost. So I'm a Swiss watch when it comes to billing. I've always made it a priority to complete my billing within the first week of the new month for the prior month. I'm looking at which projects are approaching and dropping below our target profitability. Then I need to dive deeper into the time and expense reviewer to understand why. In the time and expense reviewer, we need to set up a few filters, as I said, time period, project by phase, then item. In this case, I'm looking at sections and why a schematic design section takes 83 hours and being worked on by 4 different people. Time to talk to my team and understand their thought process for drawing the sections. There might be a valid reason. Be open and be curious to discuss and understand the why. Then share the outcome of the hours, which might affect the project to be over budget. Is there a better way for the team to divide work to be done more efficiently? Again, use the data as information for discussion of your firm's core values and philosophy and an opportunity for improvement. It's not meant to micromanage or finger point with your staff. It's okay to make a mistake, but let's learn from our mistakes and not make them over and over again. Let's look at project profitability factors. 1, the fee's too low. This might be because you underbid the project by mistake or for a reason, such as this is a highly visible project, a portfolio piece for a friend entering a new sector. Whatever the reason, it's up to you. Just be aware of this. We discussed this in webinar 3 on understanding fees. Second, the project schedule became extended and/or the project cannot afford a full-time person. You need to discuss the schedule and hours available at each phase with your team. Set a goal of how many hours are to be anticipated. Check in at 25, 50, and 75% completion and see how you're doing. Checking in at the end of a phase is too late. And then I like to have a 10% contingency in my budgeted hours. So if we do go a little over, I'm still okay. 3, inefficient or inexperienced staff, or maybe not the right staff for this project. Take the time to properly train your staff to perform the tasks being asked of them. Investing this time will pay off in the future. Teach them to fish. Do not just give them the fish, or continuously take the approach, I can just do it faster myself. In the short run, that is true, but think the long game. This approach will cause you to be the bottleneck forever within your firm. 4, client-related causes such as a revised scope, revised program, changes to design. Is this the right time to ask for an additional service? If you think yes, tell your staff to track this time as an additional service, and you can decide if you want to charge this or not. This makes it easier than going back through all your time slips and deciding which is part of the revision or not part of the revision. But with additional service, always Do not just send an additional service. It must be approved and discussed with the client. But I do like to just track that time to have already grouped that I can then have to talk with the client and know what the scope is. But try to get the additional services before you put in the time, not after. Then 5, are there governmental agency issues such as zoning, code, building and safety, permitting issues that could cause an overrun? 6, the office does not have templates, processes, or other tools in place, and therefore you're inventing or reinventing the wheel for each new project. Have systems in place. So any system we put in place needs to be used. Catching a project that is at risk early allows for correction. The contract analysis report tells me the percent I have spent of the fee versus the percent billed. So core uses the word estimated percent complete versus actual percent complete, but it's more accurate to say that the labor costs spent in dollars versus what has been billed in dollars, both based on the bill rate. Unfortunately, there is no software available that tells you what percent complete you are with your deliverables. This comes back to the PM knowing and having an instinct that if you're 50% done with the set, you can therefore bill 50% of the contract fee. You can also jump to the projects tab and click performance to see the service amount at the cost rate values. In this example, $89,231 cost of build versus $81,475 billed with a negative profit or loss of, in this case, 10%. So this is an example of spending more hours than planned, or worse, not having a plan, and this is the outcome. In the Save tab, you can scroll down and see the build versus billable versus cost. This is saying the number of hours worked on the project equals $130,526 at the bill rate, but only $81,475 were billed. On the left, the blue curve is the total billable spent on the project. The green is what you billed, and the orange is the cost of those services. The green build always wants to be higher than the orange cost. Houston, we have a problem. Let's address it before it's too late. Here, this graph reflects a profitable project, but there is some additional profit left on the table. The gap between the blue and the green line is the profit left on the table due to not billing for every hour worked. So this is not bad, but it's an opportunity to improve. That was a lot. So we'll move into Q&A. Before I do, I want to remind you, my spreadsheets are available on my website at douglasteager.com. Hopefully, if you implement just 1 or 2 of these suggestions from this webinar, it can shift some aspect of your life just a little each month. If you continue and build on those ideas that work for you, the payoff in the future is huge. To summarize, look at both project costs versus office costs. Determine your pay rate, cost rate, and bill rate. Update the cost rate twice a year when your office expense have a significant adjustment. Analyze your utilization rate versus your efficiency rate or your realization rate. You need to look at both of these numbers. Determine your maximum billing potential and then set a monthly goal of what you want to invoice each month. And then track this data. Use a scorecard to see trends over 12 months and then over 12 years. So we're going to jump into Q&A. I'm going to put on the video and then we'll move into, we'll leave this up for a while as we go through the Q&A. So Courtney, you can jump into the questions. I know that was a whirlwind of information. So the poll question is up. It's just, do you want a demo of BQE Core? And if you're not using a firm management software, or if you're thinking of switching to something a little more sophisticated, get a demo. These programs are so deep with setup that you need someone who knows the program to walk you through it. You can't just download a demo version, play with it, and understand what it can do. So if you haven't already using Core and you're thinking about it, get a demo. And if you're investigating one of these programs, just get demos. It's a lot harder just to download a version and start playing with it with yourself. Let me turn on, I'm gonna stop. Oh no, I'll keep the sharing up because we'll keep this up. And I will turn on the video. Welcome back. It was live because my electrician is here today and I had to tell him not to cut the power. Courtney, any Q&A that you want to come up with in the chat?
Yeah, we've had a few questions submitted in that Q&A at the bottom of your screen, so we'll try to get to as many as we can. One question here from Andy. He asks, how does a partner set their salary? It impacts the profit calculation. So
Great
how would you
question.
recommend
So
doing that?
there's two approaches. A lot of partners and their accountants tell them, take a low salary and take all your money in distribution. That's not going to give you an accurate cost rate. I think you have to have a fair salary for a partner in your market sector and in your geographic location. In Los Angeles, I think that can be anywhere from 150 to 350 and sometimes even higher for larger firms. But just pick a salary that is really fair for your area. And I want you to have a salary and distribution. But if you take an artificially low salary of 50,000 or 100,000, I think that's a disservice to understanding what your true cost rate is. So put in an accurate salary for cost rate. If you're not generating that amount of money to be able to take that, there are exceptions you just have to look at. But I think a partner should be paid more than his highest paid employee. And if you're not making money, are you doing this for a lifestyle business, or is it time to consider, can I be a great firm? Can I work with an established firm and make more than I'm doing on my own? But it's just a trade-off in a work-life balance.
Great point. We have another question that asks, how can a small firm sustain the business, and how can clients understand the fair value of the work fee for a specific project type?
Another great question, and it's all about storytelling. I think selling is shifting into storytelling, not selling. Once again, you need to have the ability to bring in work to tell the story of why your firm is different, of the value that you're bringing to your projects. That's a whole different webinar. There's a website called StoryBrand, one word, storybrand.com, that talks about the importance of storytelling. There's a lot, Core puts on a lot of other webinars about marketing and storytelling. It's different than what we're covering in this webinar, but it's one thing that is the heavy lift to really define what are your differentiators. And this ties into strategic plan and mission, vision, values, core values. I think defining all of those will help attract the right clients that are in alignment with what you stand for.
Great. I love StoryBrand too. Another question we have is, can the spreadsheet that you were kind of showing us throughout this, can it be adjusted to a 32-hour full-time work week and unlimited PTO?
Yes. So on the far right of the spreadsheet, there's full-time, part-time. It's based on 40-hour weeks, but just make it 0.8, 20%, 5 days. Yeah, just make it 0.8 for a 32-hour work week. Or if your work week is just 32 hours, we can adjust the 2080 down to what that would look like. And you can do that on the second tab. But the spreadsheets are unlocked, fully editable to make it work for your firm. The short answer is just change full-time, part-time to 0.8.
Gotcha. A few more quick ones we'll try to get to. Can you remind us of the formula to get from BEM to NRM, and where do you put the 35% profit?
It's on the spreadsheet. If you download my spreadsheet, it'll be very obvious there. It's highlighted. You only manipulate the cells that are in red. Everything else is a formula, and you can just enter that information and get the data out of it.
Yeah. And we'll do just one more. Should all projects have fees based on hours?
Well, once again, even if you have a fixed fee, you have to understand, what does that fixed fee mean in terms of hours? Because you can't track money to, well, my whole concept is you can track money to time, but you have to break it down into time. So if you take your fee divided by the percentage of everyone's bill rate, you'll understand how many hours each staff member can work on the project and still maintain profitability. And I have a spreadsheet for that on project budget and fee estimation and a webinar on that. But yes, every project needs to be broken down into hours per phase and hours per person. And then you can track how are you doing on meeting those goals.
Wonderful. We are at the top of the hour, so I will pass it back over to Rebecca to close us out.
Okay, thank you, guys. I know it's a ton of information, but I have some group webinars, groups that you can join that we discuss this, and private coaching if you want some one-on-one assistance.
Awesome. Thank you so much to BQE. Thank you, Douglas. Thank you, everyone, for joining us. We'll go ahead and submit your CE, and we'll see you on the next one. Have a great day.
Thank you all.